Welcome to our annual investor meeting. My name is Lauretta Reeves, and I'm going to talk about our international portfolios today. First, a letter from compliance. Basically, nothing here should be construed as an invitation or solicitation to buy or sell any security. This presentation does not contain personalized legal, tax, investment, or financial advice, and one should consult a qualified advisor to obtain advice suited to their personal circumstances. As I mentioned, I'm going to talk about our international portfolios. Kale will be discussing the Tarpon portfolio, and in a further review, we'll be talking about different retirement plan options. Now, I'm going to repeat this slide again, is why should you consider investing in international equities? One is opportunity. There are stocks abroad that you cannot buy that are domiciled not in the U.S. but in other places that give you an opportunity to explore other industries and segments. For instance, Nestle comes to mind, as well as GlaxoSmithKline, which is a pharmaceutical company, and a whole host of companies that offer more opportunity than just a U.S. set. It also gives you a diversification, as companies might be in countries that are in a different economic timeline than that in the U.S., and so this can increase the diversification of the portfolio. It also is a method of hedging your currency, and all of these offer an opportunity to actually lower your risk versus reward opportunity by investing international equities. We offer three major international portfolios. Frigate's approach is for capital appreciation, and one of the main criteria for selection for stocks for that portfolio is the future price to earnings of the company relative to its history. So we're looking for attractive valuation in companies. This does not preclude dividend. That's also included in the opportunity for returns on investment for Frigate. Treasure Harbor focuses on dividend yield. So it's more, even though it is equities, it's more focused on what the dividend of the company will be in the future, although valuation is still considered. Yellowtail is a small mid-cap international portfolio where we're looking for faster growing companies, although PE and dividend yield are considered as well. This is the historic returns through April 30th of each of the portfolios. If you'll notice, the inception dates are different, which is one of the big drivers for the difference in performance. In general, since inception, both Treasure Harbor, Frigate and Yellowtail actually have been better their benchmark by about 300 basis points, although Treasure Harbor has trailed its benchmark by about the same. As we can see, last year was a difficult year. Frigate and Treasure Harbor did better than their benchmarks last year. Yellowtail continues to be a very volatile type of folio, although it has offered good returns since inception. This year, we've seen a recovery through April in all of the portfolios until May. May, we do not have audited performance for, but we saw between a 300 and 600 basis points decline in performance in that month, mainly in the last week of the month. However, all the portfolios are still in positive territory. I'm showing you the sector allocation of the different folios. As you can see, they are different for each one. So there's good diversification within each of the international folios, but they also offer good diversification among each other. That is the same thing with the geographic allocation, where depending upon which folio you're invested in, or if you're invested in all of them, you're going to get different exposure both to companies in different countries as well as currencies. Now, for the purpose of this presentation, the Euro area includes all of the countries in continental Europe except for Switzerland, which means it does include some countries that don't trade in euros as their main currency, which includes stuff as Sweden and Norway and Denmark. So why have the markets been so volatile, and why do they continue to be that way? Well, one of the usual reasons. We are seeing a slowdown in the global economy. China, for instance, is slowing down 200 to 300 basis points a year, although still relatively strong. But overall, we're looking for economic growth on a global basis to be between 2 and 3%, excluding some big concern. There's the typical geopolitical concerns, Iran, Iraq, emerging markets, and inflation is a two-edged sword. In some areas, we're getting inflation, which has caused a pressure on costs, and in the U.S., in other places, we're seeing some disinflation in some areas, which makes it difficult actually for the Fed to try to manage basically what it should do with interest rates as to whether it should encourage growth at the risk of increasing inflation or if inflation is a problem. So it's something that we're going to be monitoring going forward. What we have seen that's a bit unusual over the past couple years is the rise of something called populism. That's defined as a situation where basically the general populace is dissatisfied with the elite that they've elected or that's currently within power, and therefore have been putting pressure, or both through elections and through protests, on the ruling parties to make changes to be more protective of them within their own country. You can see this in, for instance, the protests that we've seen in France with the Yellow Jackets. And one of the big, really examples of populism has been Brexit, where basically the UK citizens voted in 2016 to really break away from the European Union when it comes to trade and other issues. Brexit has caused a lot of uncertainty going forward and a lot of volatility because it's not been decided exactly how the UK, and even for sure if the UK is going to exit with the EU, although it is likely to occur later in this year, but it has been delayed several times already. Also related to populism and protectionism has been the rise of trade wars. We're seeing this especially with the U.S. and China trading barbs back and forth, and the U.S. now in Mexico. The threat of trade wars increases the risk of increase in input prices, which goes back again to the concerns about inflation. The difficult thing about all of these challenges are uncertainty, and companies are having trouble preparing for what they don't know is going to happen. The thing is, with uncertainty, there is a lot of volatility, and that also gives us opportunity. For instance, when the markets were really high last year, I was at a point where I was starting to sell off securities that had got expensive, and then that raised a lot of cash in the portfolios, which then gave me an opportunity when the markets fell at the end of last year to buy back stocks that I haven't been able to do so before. Nestle, as for instance, bought that back in the portfolio, and LVMH became a stock that was sold earlier that became cheap that we bought. Also, there is a natural long-term type of bottom with stock exchanges and stock prices, because companies will take advantage of volatility and lower prices by engaging in merging acquisitions. We saw a bid last year for Sky PLC in the UK that we sold out of the portfolio. We had Essilor and Luxottica have a merger, which increased cash in the portfolios. And we've seen that also in France. There was a merger of some of our French IT companies. So this is something that actually, when prices get cheap, there's actually been some benefits to the portfolio as we see mergers and acquisitions. And also there has been opportunity in sector changes, sector rotation, if you will. So for instance, what we're seeing is that we're selling off some of the stocks and sectors that still have done well during this. For instance, for Rio Tinto and BHP, which are iron ore companies, which have shown great price appreciation due to some disruptions in supply. And then we're taking advantage of that to buy some stocks in other segments, such as IT in certain places in Europe and in Asia, actually, where we've seen the stock prices come down. And so hopefully we'll continue to be able to take advantage of sector rotation. Finally, what I wanted to mention is that the opportunity set in the international markets are very attractive right now as far as valuation is concerned. The developed markets stocks and emerging market stocks are trading at really big discounts to the U.S. right now. I would say yes, there's a reason for that right now because of the uncertainties that we were talking at before, although those uncertainties impact U.S. stocks as well. But right now, I think this is an excellent time, especially with the strong dollar, to be investing internationally. So please let me know if you have any questions. Please feel free to follow up with me. Thank you.